Hi everyone, this is Jordan and I am in group 8, and our company that we are doing the analysis for is for a flower shop in Sebastian, Florida. Sebastian, Florida is a small little town on the coast, on the Atlantic Ocean side of Florida on the coast. So my presentation is for the income statement, and we're just going to kind of go through this line by line so you can see how we got our numbers here. Everything that we did will be carried forward through the 10 years, except for one line item when it comes to depreciation, and I'll explain that when we get there. So to calculate our sales revenue, we took the population of Sebastian, Florida, and we times that by the national average of flower expenditures, which we found from the BLS website. And then we divided that by the number of competitors in Sebastian, Florida, and there were 9 of them. So that's how we calculated our sales revenue number. In floral shops, there's a line item called wire sales, and they're wire in and wire out sources of revenue. Only about 13% of those come from, or 13% of total sales revenue is what we use to figure out the amount of wire sales. So that's how we took the sales revenue amount times it by 13% is what we figured the percentage of sales would be from wire sales. In order to make sure we get the correct gross profit, we had to multiply the wire sales by the amount of revenue received from the wire sales, because there are, when you do wire in, you only get 73% of the sales, and when you do wire outs, floral shops only get 20%. So we took those and combined them together to get an average of a revenue of 53.5% based on the 13% of sales. So that's how we got our wire sales adjustments, and we end up subtracting that number from our sales revenue in order to get our gross profit. With returns and discounts, we figured that only about 5% of our sales revenue would either be discounted or returned. And then our cost of goods sold, we figured that only about 33% of our sales revenue would contribute to the cost of goods sold. We used that number as we found that to be the typical amount for the floral industry of what the cost of goods sold was in relation to sales revenue. So our sales revenue, or our gross profit, is our sales revenue minus our wire sales adjustments minus our returns and discounts minus the cost of goods sold, and that's the number we come up with for year 1. Moving on to the expense portion of the income statement, our salaries and wages, we took to calculate the salaries. We calculated that by taking the total available working hours for 1 full-time employee and 1 part-time employee, which if we go up here to D11, or I'm sorry, for D10, we calculated the average number of labor hours available as 3,120, and then we times that by the average total cost per labor hour. And we also included the tax withholdings. In Florida, there is no state income tax, so that we included the federal income tax rate and Social Security and Medicaid into that total cost per hour number. So if we go back down here to our expenses, our general and administrative expenses were calculated as a percent of sale. We used 15% to determine the expense for the year. Our mortgage, the mortgage payment was calculated by using the amortization table off a base loan amount of $168,454. Building and insurance was calculated by taking the building value and multiplying it by the average cost of insurance and the property tax, which was found through research. Building maintenance, we figured that it would only be about $150 per square foot for the month. And so if we are, $150 per square foot per year. And so our building is about 1,000 square feet, so we totaled that expense to be about $1,500 a year. And then for our depreciation expense, that was calculated by adding the value of our plant, property, and equipment, and then dividing it by the depreciation years. And we took the average of the depreciation years between our 3 assets that needed to be depreciated. But in year 5, we end up, the allotment for depreciation for vehicles is only 5 years when it's associated with a business. So at the end of year 5 here, we calculated that that the vehicle would be, depreciation would be done, and so we needed to then go back and recalculate the depreciation years without including that 5-year total for the vehicle sales. So for year 6, there's only 2 assets being depreciated. So we took each of their depreciable years and divided it by 2. And that's how we got, and then obviously divided it by the total of the value of the assets. So that's how we came to that. So, and then moving on down here to the income before taxes and interest, that's just taking our gross profit minusing our total expenses. And then our interest expense was calculated based off of what we figured over here in our amortization expense. And we have the rate is 5%. So that's how that was calculated. If we go back to the forecast, our extra bank loan, that number is determined by whatever is left down here to balance at 0, and then times by the interest rate, which we decided would be 7.5% based on previous case examples that we've done in this class. So that sums up the income statement for our company. And we can see in the first, 2 years, we end up with a negative net income. But starting in year 3, our income pretty much almost, it starts doubling there and then doubles there, and then it kind of tapers off at like 2.5% going forward. So thank you for taking the time to watch this, and I'm looking forward to your critiques. Maybe if I can turn this off here.